Welcome to Store University Lesson 2, How to Calculate Returns on Equity and Get Really, Really Rich. I'm Chris Volk, CEO of Store Capital, and this is the second lesson of what we plan to be 10 small introductory courses that are designed to help you evaluate and get the most out of your business. Business people do not have to be math wizards, and in fact, most are not. But business people tend to have a few things that they know, like how much cash is in the bank, or how much money do I have to invest personally to make this enterprise work. Here's one more important thing to know. What is my return on equity? Equity is the amount business owners need to invest in their companies. It's their own money, or YAM, as we know from the prior lessons. And equity changes constantly. There are generally two sources of equity. The first is personal funds, and the second source of surplus cash flow is the cash flow from the business that you elect to retain in the business. These are basic financial concepts that are not always mirrored by your financial statements or your tax returns. And so it follows that calculating a return on equity is not something that requires a financial statement. If you are at all familiar with financial statements, you'll know that there are problems with them. Financial statements provide a sense of what has transpired, but they do not mirror reality. And the lack of clarity is nowhere more profound than in the area of shareholder equity. In accounting terms, a company's assets are equal to the sum of its liabilities plus its shareholder equity. Only a company's assets will seldom equal the cost of the actual assets deployed. Items like accumulated depreciation reduce that cost. So do asset or goodwill impairments. And sometimes strange non-cash items that you don't pay for at all just pop up. If you run a real estate investment trust like I do, a favorite example here is something that we call straight-line rents receivable. Liabilities can likewise include a number of non-cash obligations that are posted to the account for the timing differences between when cash is paid to you and when you have to provide a service. All of this means that the equity account is really effectively a plug number between assets and liabilities, which are both loaded with non-cash accounting conventions. So if you're calculating your return on equity by dividing reported net income into reported shareholder equity, you're going to be incorrect. You may be in the ballpark, you're not going to be right. In our next lesson, we will go over the three major components of equity returns. Until next time, I'm Chris Volk. Thanks for joining me on this value creation journey.